good morning. Is anybody confused about the state of the economy? We're hoping to add a lot of clarity today. When I say we're, I really mean Jim Doti, who's the expert. Jim is really a national treasure. He's the former president of Chapman University, for which he served 25 years from 1991 to 2016. But prior to that, he joined Chapman in 1974, and a few years after that founded the university's Center for Economic Research, which has become world-class. The jewel of that Center for Research is its annual economic forecast. And over the last 10 or 15 years, Jim's team has created a forecast that has proven to be more accurate than just about anybody. The major investment banks, the major central banks around the world. This is the person you listen to. He's a real Renaissance man. He's completed 60 marathons, including Boston 10 times. He's climbed 5 of the 7 summits in the world as a mountain climber. And if that isn't enough, he's an author of several children's books. So Jim, I know you want to start out, you want to level set with some slides, so why don't you do that?
Thank you. I'm going to get up. Thank you very much, Rich. I'm going to give you some slides and then try to get through those as quickly as possible and then start our discussion. Thank you all for being here. I'm honored to be part of the Montgomery Summit and thank Jamie for all he does and his leadership in bringing us all together. I'm a runner. I have to tell you something really exciting in my life. I turned 75 recently. Now, people usually bemoan the fact as they get older. Runners actually look forward to it because that moved me into the 75 to 79 age cohort. And, in all my running, the 60 marathons, 10 Bostons, you're in an age bracket and you get an award for first, second, or third. Now, I've been third a couple times, second a couple times, never first. Move into the 75 bracket. I don't know if you know this, but for some reason, when you go from 70 to 74, 75 to 79, there's a big drop-off in competition. And not only that, you're the newest and youngest kid on the block. So 2 weeks ago in Orange County, I came in #1. So I'm sorry to start with such an immodest comment, but it just shows you there are some good things about getting old. I'm going to just kind of give you, we only have a half an hour. I'm going to focus here on a theme of my remarks that I'm going to have next month at our update forecast, namely that we believe strongly we're headed for a recession. I'd like to give you some evidence as to why and maybe what are some of the implications of that financially. This gives you the federal funds rate. Those gray bars are recessions since 1970, and you'll see this is the lead between the time the Federal Reserve Board started increasing the federal funds rate and following a more contractionary policy, and the actual beginning of a recession as timed by the NBER. 4 quarters in 70, 7 quarters lead in 75, 12 quarters, 4 quarters. Many consider that 80 to 82 back-to-back actually one recession, but I'm treating them as 2 here. Then you have 14 quarters, 7 quarters, and 14 quarters. If you take an average of that, it's somewhere around 12 quarters, which would suggest that if we started in the first quarter of this year, we wouldn't have a recession on average, just on average, until 2024. But I'm going to present a reason why I think it's going to be sooner rather than later. There it is, 10-quarter or 2.5-year average. Now, some analysts will point to the fact that the Fed has not always led to a recession, that there were 2 times when there was a tightening and the so-called soft landing. And these are the 2 times after the 80-82 recession and then the mid-90s. And let's just look at those. Here, if we look at the federal funds rate and percentage change in GDP, there it is again, and notice what it was fighting. There was a little blip up in the year-to-year growth rate in GDP. So potentially the Fed saw that as inflationary. Now let's look at what was going on the price side during those two soft landings. Here they are. First of all, after the 88-2 recession, you have a situation where the year-to-year change in the price rate went up from maybe 3 to 4%. So nothing significant, only up to about 4%. Here you don't see any change in year-to-year increase in inflation. So what was the Fed fighting? Back then it was Alan Greenspan. If you look at quarter-to-quarter inflation, it did go up from something like 2 to 4%. So there was a blip. There was a blip. You don't even see it here, but if you did quarter-to-quarter, you would. I'm arguing that those two soft landings are nothing like what we are experiencing today or this year. Much sharper increase in the year-to-year change in the inflation rate. More like what happened in the 73 to 75 recession, as you can see here. And here's an expanded version of that. Inflation going up, federal funds rate, Federal Reserve Board tightening up. It took, as you can see there, something like 1, 2, 3, 4, 5, 6, 7 quarters, and then it backed off a little bit, and this is very important. Inflation continued to increase during the recession. Now remember, what the Fed is fighting here is not a recession, but inflation. That's why soft landings don't occur. In an economic sense, to bring down inflation, particularly rampant inflation over 5%, the thing you need to do is reduce spending. It's the reduction in spending that brings down inflation. A reduction in spending, hello, it's a recession. And that's what happened. And when the Fed realized that even though they're in a recession, inflation is still increasing, the Fed was increasing interest rates during the inflation, and it was only perhaps mid-recession that inflation finally started backing off, and then so too did the federal funds rate. Notice that to bring that inflation under control, it took a 600 basis point swing in the federal funds rate to bring that under control. That would suggest if we're starting from 0, it would be 6% fighting a similar inflation. Here's the one area that I have not seen analysts commenting on, and why I think this recession will come sooner, not 2024, more likely 2023, even earlier in 2023, a year from now. And that is what's going on in the fiscal side. Everyone is focusing on monetary policy, not only higher federal funds rate, but quantitative tightening with the Federal Reserve Board over in a year will be closing in on $80 billion of sales of T-bonds and mortgage-backed securities. Over and above that, what people are missing is what's going on the fiscal side. Here are the 2 times since 1960, history of the U.S., where the budget deficit really increased significantly, like over $1 trillion. And that was during the Great Recession of 2007 to 2009, and much more recently. What we're talking about more recently is between 2019-20 fiscal year, a $3.1 trillion deficit. The following year, a $2.8 trillion deficit. And now, in the current fiscal year, we're talking 21 to 22, down to roughly $1 trillion. That's a sharp drop in fiscal spending, and on a quarterly basis, you're talking about $200 billion drop, but this will entail an $800 billion decline in fiscal stimulus. Federal Reserve still running a historically high deficit, but much lower. And remember, economics is all about the margin. It's about the change. And we're dealing now with that much less spending being taken out of the system. Here's a comparison of the Great Recession with what's going on now. As you can see, this is mild, 200 billion compared to this $800 billion swing in 1 year, and then continuing swings after a second year. So we feel not only do we have very, very aggressive monetary tightening, contraction, but it's also happening on the fiscal side that has never happened before in any of these other examples. In fact, over here, 07 to 11, when that was happening, when the Fed, this was after the 08-09 recession, very interesting. We had this drop of only $200 billion. Well, a lot, but relatively small compared to what's going on now. But when that was happening, that was when Ben Bernanke started quantitative easing. So you had some fiscal contraction, but you had historic monetary expansion offsetting that. Here you have a double whammy and leads to my pessimism regarding a recession. And what does that mean? Implications for the stock market. Oops. Well, we missed that. Could we have that last slide on again, and maybe we can continue the discussion? I can tell you what it is. Every recession, there it is, the gray bars, this is what happened to S&P 500 year-to-year basis. You could see those declines. That is an average decline of 22% in every recession. And that's even including the 80 recession, which is really a back-to-back recession where it was zero. That's in that average of zero change. Overall, 22%. Where are we now? Has the market discounted it? As you can see, on a year-to-year basis, we're at about zero. Market now is about where it was last year, which suggests that it has not fully discounted the prospects of a recession. With that, thank you.
Usually at this point in the conversation, I say from your lips to God's ears, but I'm hoping God's ears are plugged after hearing this.
Sorry for the pessimism.
And how much do you think the inflation that we've experienced over the past year is really monetary induced, and how much of it is just sort of supply chains haven't really recovered? And just take China. I mean, China's zero COVID policy is the most self-inflicted damage in the world today. It just boggles the mind why they would persist doing that. And that's part of the supply chain problem. Russia and Ukraine is a smaller part of it, but how much of it is that? I mean, do you think the Fed is overreacting to simply the monetary overflow that happened after COVID?
Two things. It's not the Federal Reserve Board alone. It's not the Treasury alone. They did it in tandem. Just talked about back-to-back $3 trillion deficits. Never happened, nothing even close to that. So you're talking about $6 trillion of expansion, of additional spending. Now, ordinarily, if the Treasury has to fund that deficit, has to sell it in the open market, that would change interest rates. It would not have that significant an impact. The difference this time is that the Federal Reserve accommodated that, monetized that by basically buying all of that debt. So two things. You had a very, very expansionary fiscal policy, but it was made much more expansionary because the Federal Reserve Board was buying all that debt and increasing the money supply. A year ago, when Jerry Powell was still talking about transitory inflation, at that point, the money supply, M2, had already been increasing 25%. Unlike anything that's happened since World War II. Last year at our Chapman Forecast, 1 year ago, there was that, is it new monetarism? Remember new monetarism? I'm not talking about new monetarism anymore, where deficits didn't matter, money supply didn't matter, and the old monetarism. My teacher, Milton Friedman at University of Chicago, and there was a great acid test as to new monetarism, old monetarism. We forecasted with a 25% increase in money supply, inflation wasn't staying at at the time 1.8%, it would be a significant increase, and here we are today. But it was because both things were happening. Your second question relating to supply chain, obviously when you have that kind of a demand increase, it's going to create supply chain problems, and what we've seen in Long Beach and so on. And that's what the Fed is fighting now, to get those back under control by bringing down demand. And my message here is the only way to get the kind of inflation we've created under control is to bring down spending. But bringing down spending is a recession. By the way, there are a lot of lessons here to be learned. This is not all bad news. There's a lot of money that could be made if you agree that the market hasn't fully discounted the future direction of the economy. I just spoke to a guy who was selling 30-year bonds short and has made a ton of money.
Well, in terms of recessions past, going back to I was hopeful at the beginning of the 2020s just simply because it rhymed, that the 2020s would be like the 1920s, which boomed, but of course the boom was about a 7-year boom because you had the after effects of World War I, the Spanish flu, that horrible stock market crash and recession of 1920 and 21. It really didn't boom until about 22, until 29, but it was pretty short-lived compared to the Great Depression of the 30s. We have the 73, 74, 75 recession. We have the 2008 and 9. Historically, how bad, where would you put what you think this one is going to become? Will historians look back and see that it was mild and short-lived, sharp and short-lived like 82 and 1921, or sort of give us context of both the duration and the trough?
I think this will be a very, very serious recession, Rich, and mainly because of the adjustments and what a return to normalcy entails when you consider the fact that we have been through a 10-year period of essentially zero interest rates. Do you know what happens over a 10-year period when you price capital at zero? Leads to all kinds of distortions, one of which is there's a lot of junk debt out there. There's been an incredible accumulation of debt. Why not? If interest rates are zero or close to zero, it's a great incentive to borrow. The adjustment that will be necessary over this long period of quantitative easing to all of a sudden quantitative tightening will be enormous. So I think it's going to be a serious recession. Now, as to whether it's short-lived, long, that will depend upon, at the time, what action the Federal Reserve Board takes. For example, the COVID recession is the shortest recession in the history of the United States since NBER started recording it back in 1880. Shortest recession. Why? Because it had the most incredible monetary and fiscal expansion to fight that inflation, but it was a fight that ultimately led to long-term consequences that we're dealing with now.
How much do you weigh geopolitical events around the world? At 2 o'clock, I'm going to be talking to Marko Papic of the Clock Tower Group on geopolitical events, and he's, like you, has been a really accurate forecaster over the years. Does that go into your calculations, or you are a disciple of Milton Friedman. Milton Friedman said inflation is always and everywhere a monetary policy, but are there other factors like geopolitical factors that you throw into your formula?
Rich, certainly these factors are relevant. The Russian-Ukrainian war is certainly something that will exacerbate inflationary pressures, supply side problems. But fundamentally, in fact, my dissertation at Chicago was how most external events have insignificant or very minor impacts on the economy. And I believe that's the case for this war and other events that will affect not only the economy, but military events and trade policy. Much, much more important. If you really want to focus on the central elements of what's going to lead to recession, prosperity, inflation. It's paying attention and focusing on what's happening in the Federal Reserve, what's happening on the fiscal side of the house, because those changes will have much more significant impact. COVID obviously was an anomaly, certainly an anomaly. But bearing something like that, I would focus on those important factors.
When you look at, you were already running the Center for Economic Research at Chapman when the U.S. finally got itself out of some really deep, persistent inflation of the late 70s and early 80s. And Paul Volcker just said, I mean, this is my layman's understanding of it, you know, we're going to take the pain until this is over, and accelerated that pain and caused a very sharp but short-lived recession. I mean, what was that well handled, or could have been handled differently? The outcome was pretty good because by 83 and 84, the economy was booming again, and the stock markets also.
Well, I really believe Paul Volcker handled it well. It was a costly back-to-back recession, broke the hump of double-digit inflation. What was not handled well was how we handled inflation in the 70s. Remember, it was Richard Nixon who, was in 1972, called for price controls, on energy, disaster, well, even on other items as well. Gerald Ford had the smile button, or let's defeat
whip inflation.
Whip inflation. I would not categorize those strategies as very, very helpful, and I think allowed inflationary pressure to continue for as long as it did, which made Volcker's job to contain it much more difficult and led to a very serious recession. But it did, again, to break the back of inflation then, it was to bring down spending significantly. And you had an 80, you had an 82 recession, the most serious that we've ever had, except for the more recent Great Recession of 07 and 09. But in that case, you also had geopolitical factors like oil. But you had an inept fiscal and monetary policy worsening it by creating too much money, and a collaborative relationship between Arthur Burns and Richard Nixon, which was the basis for that double-digit inflation and what happened during the 70s, calls to mind the importance of having an independent Fed and Treasury.
You're not a stock market forecaster per se, but you did show some slides that correlate what you've said with the S&P, and the S&P is down, what, 20 or 25%? A lot of people in this room, if they're with publicly traded companies, are down way more than 50%. The whole SaaS software category has just been pummeled. Some really promising companies are down 75%. Do you, how much more pain do you think there is in the stock market? And within the stock market, do you think the pain, there's more pain to come for this particular set that has already been just killed?
Rich, all you can really do, I'm an econometrician, there's quantitative history. And you have a situation where if you look at every recession, thinking of this as an average recession, when I think it will be much more serious. But even if it were an average recession, relatively mild recession, the average drop in the market year to year is about 22%. If you combine the back-to-back recessions, it's actually an average drop of 25%. So there's, I think, a likely decline that will continue. Looking at interest rates.
Well, 73, 74 was nearly half.
Yeah.
08 and 09 was more than half.
Yeah, it was we have 45% declines during two of those recessions. But you know, the thing that you have to focus on here is right now we have a federal funds rate of 1%, going to move up to 1.5%. Does anybody think it's not going to hit 2.5%, 3%, when there was a 600 basis point swing to get a previous similar inflation under control? So even if it were to go to 4 to 5, what do you think's going to go? What's going to happen to a 30-year, 20-year T-bond? You think it's going to stay at 3%? You think maybe it might go to 4, maybe 5, when mortgage rates are already at 5.5? If we just sit back on that and contemplate, well, yeah, it's probably going to go up, and you're not you're thinking about, maybe I should sell some of those T-bonds short. Do you know what the appreciation would be going in at 3 and that great, just going up to 4%? Call your broker and find out.
Housing has been a big winner of this inflation period that is now probably coming to an end. What are your forecasts for the housing market, in as much as if what you say about interest rates is true, and I believe they are, then mortgage rates are going to follow?
Yeah, you have a mortgage rate that was, because of zero interest rate policy, had moved to 2.5%, 3%. Now you're talking about 5.5%, close to it, and before long it will be a doubling from 3 to 6%. That, one of the things we found in our Chapman model, which is, by the way, the reason I think it's as accurate as it is because we have students constantly updating it, students in econometric, quantitative, data analytics, so that's a big, big help. Another factor is that it's a strong monetary component, and thirdly is because it's based on year-to-year percentage changes rather than quarter-to-quarter, which eliminates a lot of the noise. Well, getting back to mortgage rates, we find that it takes 1 to 2 quarters before the increase in mortgage rates has an impact on housing, residential construction. So just give you an example of our forecast, looking at our regression equation, going to the end of the year, factoring in an increase by year end of a 6.5% mortgage rate, that will lead to a drop in residential construction that will shave roughly 0.6% off of real GDP growth. That's just from one small component of overall GDP that comprises maybe 4%. That alone is leading to more than a 0.5% decline based on, that projection.
Yeah, not to mention the psychological damage people feel when Zillow is telling them their houses don't go up forever. A couple minutes left. I want to switch gears and talk about your lifelong role as an educator, university president, and boy, it just seems like there's a lot of economic illiteracy, even among people coming out of college with 4-year degrees, even beyond that. What are your observations on that, and what would you do to correct it if you were czar of college education in America?
I'm biased. I'm an economist. I love economics. And I would argue that there's a tremendous amount, or there's just economic illiteracy in this nation. How a free market system works is abysmal. We're doing something about it at Chapman. We're very proud. We just announced a chair in free enterprise. The person who's going to be holding that chair is going to be having a summer program for high school students. We're going to accept up to 100 students. And the theme of that week-long session at Chapman will be on the free market and how the free market works. Before I want to get back to housing again, because just as a point, what's going to happen to appreciation? Is a question you might have. We're looking at third quarter, fourth quarter, a drop in year-to-year percentage change in price, 5% in third quarter, 10%. Even with a 10% decrease in home prices. Now, Southern California, if you include condos in that, you're talking about roughly $1 million median home price. And if you talk about year-to-year drop of 10%, that's $100,000. If a year ago, if you were to take a 3% mortgage rate, and now all of a sudden you have to pay 6.5%, even with that 100,000 savings, your payments are going to be going up. Monthly P&I, just P&I payments, will go up on that cheaper price from $2,700 a month to $3,700 a month, even though prices are $900 rather than $1 million.
So I think what you heard as we come to the end of this session is sell your stocks, sell your house, buy a big honking boat, and go on, what, a 3 or 4 or 5 year cruise around the world.
Sell short.
And come back when things are better.
Right.
Well, thank you very much, Jim Doti, for this illuminating forecast and for basically a session of tough love.
Right.
Right.
Thank you, Rick.